and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour for the closing bell. Ratings on Wall Street.
I think there were a few things that have caused panic over the weekend and clearly in today, right? I mean, the headlines, the initial stuff, the takes that came out basically said, oh my God, they've duplicated OpenAI for $5 million. They did not duplicate OpenAI for $5 million.
Well, guess what? If we can create models more inexpensively, if we can use compute more efficiently, these SaaS providers, the Salesforces, the ServiceNows, the Microsofts, those companies that we're saying they're not driving enough revenue. They'll be able to build their models cheaper. They'll be able to create solutions with less overhead expense, and they're going to drive more EPS.
Well, for Mexico and Canada, it sounds like there's some people in the administration that want to go ahead and do it. Even if the goal is to take them off, if they can get a deal. So I'd say maybe 50-50, depends on what parts of the Trump team wins out in these key talks behind the scenes.
These aren't surprises. This is just supportive. So we may have to be a little bit more patient. We'll see what the Fed has to say. The Bank of Japan raised last week, created a little bit of a headwind. So we'll see. But holding 100 in a tape like this is pretty impressive.
We got 1 hour to go until the market close, and we're taking a look at the major indices amidst DeepSeek panic, or what maybe feels like it in this market. We're going to get into this, but let's just do the numbers first. We've got the Dow up 212 points, about 0.5%. Very sharp contrasts today between the S&P, which is down 1.8%, and the Nasdaq, which is tumbling 3.5%. It looks like it's set for its worst day only since mid-December. But that could change if we go below that number. It is DeepSeek. It is sinking the market, Julie. So the issue is, if this Chinese company did what they say they did, it is impressive, right? You built an LLM, this large language model. You say you did it pretty quickly. You say you did it with older chips and fewer chips, and you did it with relatively limited financial resources. Yeah. That would be a big deal, and you can see that kind of rippling through the markets because for a range of reasons. You would think if you're a big tech investor, you would be thinking, yikes, maybe these folks are spending a lot on AI efforts that they shouldn't be, right, or they're spending less. They don't need to be, yes. If you're in Nvidia, which a lot of folks are watching this right now, you're thinking, well, wow, maybe you don't need Jensen Huang's shiniest, latest, and greatest. Maybe the older ones are okay. I will say these are claims. Yes. And certainly even on our show, and you heard that just from some of the guests, yes, there are some skeptics pushing back on some of this too. Whether they actually did this. So let's take a little bit of a roadmap as to how this is playing out in the market. I want to start with the Philadelphia Semiconductor Index, which is down by nearly 10% today. That's the most in a single day going back to the pandemic, the early sort of pandemic era. We are looking at a 20% drop potentially if it goes lower than this. Not here, but more like 47.23. But you see here, even just kind of year to date, this big drop that we have been seeing over the past few days. So that's one thing. Then if we look at the Nasdaq 100, we also see, to your point, that is just an incredible drop, especially a company the size of Nvidia. And kind of a broader question, we have some market strategists coming up too. I think the broad question of markets is do you think this is just that headline? Is it a one-day event? Or do you think, given some of the impact and the ripple effects, do you think this is the start of something broader for the market there's too? A lot of talk about speculation and this narrative in the market that is now being shaken. We should point out, by the way, Meta is up a little bit, and look Apple is having its best day in a little while. It's after up by 4% a rough stretch today. So this is not all of the Magnificent Seven, but it is a lot of them. Indeed. All right. Well, since we're talking so much about DeepSeek, I do want to break down more of what this new generative AI chatbot is and what it means for investors. So let's get to what exactly DeepSeek is and why there's so much talk about it today. So first of all, it is a Chinese AI startup that was actually funded by a hedge fund, sort of as a side project, began in 2023. And then why is it causing so much attention now? Well, it introduced its new R1 model last Monday, a week ago today. There was some momentum building last week, and then it sort of exploded over the weekend and into today. It develops these open source large language models, and open source is important. That is different than some of the models that are out there. And it also says that its R1 rivals OpenAI's model O1. So this is something that people have tried it out and said it is pretty successful. It does have some blind spots, including those that have to do with the Chinese Communist Party. People who have used this model have said it will not answer questions. It either will demur or give answers that are not in line with reality. Whatever the case, since it is open source, there is talk that that can potentially be tweaked by those who are using it for their own purposes, but that remains to be seen. The big thing here, as Josh alluded to, it says it is training this latest model cost $5.6 million, million with an M, not billion with a B. And that is the real revolution here, as we've been talking about, is that because of export controls, it apparently did this without Nvidia's most advanced and most expensive chips in a much more cost-effective and efficient way. Now, again, these claims have not been verified independently, and there is a lot of chatter, which we're going to talk more about whether they really did this, whether they somehow got some of those Nvidia chips through a back door, and that's how they developed the model. So that's what's at stake here. Now, a lot of people have been downloading this thing over the past week or so as it has gained prominence. It was number one on the App Store. I think it still is at this point. So a lot of people are interested in this model, and it had some outages. DeepSeek actually said it was because of attacks, not because of the flood of people using it, and it didn't have the capacity. It says, and again, we haven't independently verified this, but it says due to large-scale malicious attacks on DeepSeek services, we are temporarily limiting registrations to ensure continued service. And indeed, it was limiting those registrations to people with a Chinese mobile number because there was such an increase in interest from outside the United States. And speaking of the United States, obviously there's also a geopolitical element here about competitiveness. We restricted these chips to China, and now China has come up with this large language model that is, at least on first glance, comparable with the ones that are happening here in the US. So what's the reaction to that? Well, David Sachs is the cyber and AI czar that was appointed from the White House, and he says it shows that the AI race will be very competitive and that President Trump was right to rescind the Biden executive order, which he says hamstrung American AI companies without asking whether China would do the same. Obviously not, he says. I'm confident in the US, but we can't be complacent. So we'll see if there's any kind of action that comes, or if it's more just a matter of not regulating this industry to try to foster innovation. Josh?
All right, Julie, here with a closer look now at the potential shift in the AI narrative as chip stocks take a beating. We have more insights and strategy. Founder and CEO Patrick Moorhead. Patrick, it is great to see you. You are, in fact, the perfect guy to help us walk through this, Patrick. So it's great to have you on the show. So DeepSeek says, Patrick, okay, we built this LLM, this large language model. We did it quickly. We did it with older chips. We did it with fewer chips. We did it for a whole lot less money than those American companies. And investors now, Patrick, they're trying to think through, okay, what does this all mean for that mega AI trade we've been so excited about? You say what, Patrick?
Yeah, so Josh, thanks for having me on the show. First off, I don't think this is some Chinese psyop. I spent my weekend reading white papers and going through the details. And while I am not a data scientist, I do believe that what's clear to me is they used different techniques than the other model makers are doing, where they were able to parse or train maybe 5% of the data, right? That's like a 95% reduction. And then what they did is when you actually run one of these applications called inference, they did that with an exceptional amount of optimization. So here's what it means. I think this is a gigantic overreaction. I think the market should be going crazy because of the uplift of what we were looking for, which was where's the beef when it comes to consumers and enterprises, right? They're the ultimate arbiters to keep this market going. And I think it's even overblown on Nvidia. There's two ways to, and all the Nvidia ecosystem that goes along with it. And here's my thesis. So we have not yet hit AGI. And until we hit AGI on the training side, there will be an immeasurable amount of compute required to get us there. And then for each one of these steps to get AGI, you have to have inference, which is essentially running the application. Those haven't even been built out yet because the consumer and commercial demand are not there. So I think this is a complete overreaction on NVIDIA and all the companies that support NVIDIA and even the direct competitors to NVIDIA.
Patrick, I want to ask you something else because we got some reaction from NVIDIA, and I'm hoping that you can help translate it for us into non-tech speak. They talked about DeepSeek being an excellent AI advancement, and what they said is a perfect example of test time scaling. And they said that now we have 3 scaling laws: pre-training and post-training, which continue, and new test time scaling. What the heck does that mean?
Yeah, so NVIDIA sent that to me. I put my somewhat decoder ring out there on X, but it's essentially that we're putting a lot more effort into that last step called inference. And test time, there are 7 or 8 different methods that you can make that more efficient. And I think this was just bringing this to the table, that they were applauding DeepSeek and what they were able to do with open source technologies. But this is yet a third frontier for people to focus on. And NVIDIA has talked about test time before. Just now, it's getting some attention, particularly after the company put out that statement. And inference takes a lot of chips too. And as we saw with machine learning, we needed about 10x more inference chips than we needed training chips 4 or 5 years ago, when we were doing things like object recognition and making sure that you can search your photos and with ease and finding the photos you're looking for. So yeah, inference. Focus on that word.
But Patrick, isn't this at the very least, isn't this a call to the industry that maybe here in the US, we need to be a little less willing to throw lots of money and resources? In other words, this is something that was born of not having the same resources, and therefore they've come up with a more efficient system. Doesn't it call into question the whole bedrock of what we've been developing here with AI? Can it be done more cheaply and more efficiently and without all this power necessary?
It has a lot of people asking a lot of questions. I mean, we saw with Project Stargate, Sam and company said they needed $500 billion to build the next generation of AI. And this is new in that we always had some optimizations that might have been done, 1 or 2 years down the road that would make it more efficient. But being this close to the cutting edge AI, which is called a reasoning system, is a shock to the system. The other thing, though, that the counter to this is that this is what open source gets you, right? And companies like Meta really are leading in open source, where people can add improvements upon improvements to this. And here's what you're going to see in the next couple months is they're going to take the same techniques that DeepSeek has done and apply them. You're going to see OpenAI look at them. You might see Meta with Llama. You might see Anthropic integrate these. And it just makes the pie bigger, Julie. We have accelerated AGI by at least a few years. And I think the downstream impact to that is just monumental. And the whole market's missing that. We see the Salesforces, the Microsoft, the Salesforces, SAP, ServiceNow up a little, but I think they're up a lot less than we should given this breakthrough.
Last question, Patrick. I know you said you read white papers about the technology. Did you also download and actually experiment with the app?
I have. Yeah, I have the app in. And they are restricting sign up, but if you have a Google login, that allows you to sign up. And I asked it a bunch of questions, and from a reasoning standpoint, which is kind of this multi-step, complex type of mode that gives you the best answers, but takes a long time. It's super fast. Ask it any type of political question about any company, whether it be China or the United States, and it plays dumb, okay? It is very much censored, and you didn't ask this, but I'll tell you, because it's open source, you can take DeepSeek and do modifications to it to give you better answers in areas where it's not giving you good results.
Well, we'll see if that's how it plays out, right? If more people are able to use it and then tweak it because it is open source. Patrick, really helpful as we try to think through and make sense of what is going on today. Thank you.
Thank you.
We're just getting started here on Market Domination. Coming up, a full week of earnings is on deck. Remember those? We'll get you set for what you need to know for the latest round of reports. Stick around, much more Market Domination still to come. Today's tech sell-off is not what investors had in mind to start arguably the biggest week of the year so far, in terms of earnings, that is. So as the earnings season kicks into high gear, can a round of strong reports ease some of these AI concerns? For more, we want to welcome in Art Hogan, B. Riley Wealth Chief Market Strategist. Good to see you, Art. So what do you think here? Are earnings going to gallop to the rescue after this deep sell-off that we're seeing today in tech?
This DeepSeek sell-off that we're seeing in tech, yeah, I think it's what's been interesting in the first couple of weeks of earnings season is it has shifted our attention to some of the positive tailwinds. So, thus far with about 20% of the S&P 500 having reported, we're doing better than expected, close to 13% earnings growth on 7.5% revenue growth. I think that continues in a busier week that's much more diverse in terms of sectors and stocks, and clearly 4 of the 7 Mag 7s are reporting. So there'll probably be some interesting questions on conference calls about, how much you plan on spending and what's the CapEx budget look like. And I don't think that answer is going to be it's going down and not going up.
And Art, the DeepSeek news obviously, rattling some investors and those big tech names, and they're thinking, I don't know, maybe these names shouldn't be spending as much on the AI build out as they are. You were already, though, Art, correct me if I'm wrong, market weight on those mega cap AI names, were you not?
Yeah, market weight on those names, and that's because, Josh, on the 2-year stack where they had gotten to. So one at a time, if you looked at each name, you could make a pretty strong fundamental argument that they were fairly priced, if not starting to get overpriced. But we're certainly not talking about taking an underweight in this sector, because we continue to believe that's where a great majority of our earnings growth is going to come from, both this year and next. It's just at what price, and now that at what price, especially for some of the semiconductor companies, has gotten a lot more reasonable. So you've taken 3 or 4 multiple turns off of Nvidia in a single day. You don't often see that for a company that's growing, at the magnitude that it's growing. I think that's going to be true, and I think this is an opportunity there. But I certainly, the point of being market weight just means you don't need to be overweight like you were for the last 2 years because of the dominance of the AI darlings.
I was looking at some research about how hedge funds are set up within tech going into this earnings season, and they've reduced their positions quite a bit, it looks like. According to Goldman's trading desk, the net allocation from hedge funds and mutual funds in big tech, in Mag 7 specifically, is about 15% now versus 21% from a high. So it's come down a bit. What does that tell us about what earnings reactions might look like if people are not positioned like they were?
Julia, it's such a great question, in so much as I think the combination of institutional investors like the hedge funds and certainly individual investors that pushed off selling and having that tax consequence into this calendar year really caused a soft spot for technology for the first couple of weeks of January. So I think that positioning makes sense, and especially coming to an earnings reporting season, if you were really priced to perfection, which a number of the Mag 7s and the top 10 market cap names in the S&P 500 were, it probably makes sense to at least have a chance to not have to have that adverse reaction or that reaction function to anything that slips up, whether it's the revenue guide or something that comes up at a conference call that doesn't sort of fit into your model. But I would say at this juncture, with today and the first couple of weeks of January, they've plateaued quite a bit. And actually, most of the S&P 500's earnings or the index growth has come from things like utilities and industrials and materials. And I also think that's healthy, right? We're broadening out. We're not dependent on artificial intelligence and AI adjacent names, and we're starting to look at other things. And along with that will be the earnings growth for the S&P 500 this year. The percentage participation of the other 9 sectors in the S&P 500 continues to grow. So I think this broadening out theme really makes sense, and I think we'll see that continue through the earnings season.
So, Art, if I'm market weight mega cap AI names, what sectors do I want to be overweight here?
Well, we think that this is a great year for things like energy. That's probably our most non-consensus call. Energy, the worst performing sector in the S&P 500 for 2 years running. We think the multiples are ridiculously cheap. Most of the majors throw off nice dividends. So that's one sector we really like. We think the financials are probably the largest net beneficiary of new policies from a new administration. So we like that space as well. And we throw healthcare in there as well. Healthcare was, one of those political footballs that gets kicked around in every election year and then tends to have a very good year and likely starts to broaden out beyond things other than just the GLP-1 drugs.
All right, good to see you. Thanks a lot.
Thank you.
Now, time for some of today's trending tickers, sponsored by Tasty Trade. You can scan the QR code below to check out the best and worst and most traffic stocks of the session on Yahoo Finance's trending tickers page. First up, we got to look at AT&T. Those shares rising as the company reports better than expected subscriber growth and also topped earnings estimates for the fourth quarter. Some of the other numbers looking good, like new monthly mobile subscribers at 482,000. That was also ahead of estimates. And the company also signing up more people for its fiber optic internet service.
Yeah, they beat there too. They added 307,000 customers to its fiber optic internet service. That was a beat. As well. More customers are choosing and staying with AT&T, says CEO John Stankey. Verizon, remember, also posted better than expected results last week. We talked about Julie, and then I think finally we got T-Mobile kind of wrapping things up on January 29th. Nice day and up about 40% over the last 12 months for AT&T.
Yeah, and the company also reiterated its 2025 profit guidance, which some analysts said was reassuring.
Reassuring.
Yeah.
Walgreens Boots Alliance shares sliding on a media report. The private equity bid for pharmacy chain is mostly dead, Julie. That was your headline. That doesn't sound good. So this was CNBC citing sources. They said that pharmacy chains go private talks with private equity firm Sycamore Partners, mostly dead. Sycamore has been in talks, we know, to purchase the drugstore chain. Of course, this is a sector under, it's not just one, the sector's under pressure, facing real challenges, not as much foot traffic, reimbursements for drugs. Walgreens has been making moves, but it has been a rough ride for this.
It has, mostly dead. Is that a Princess Bride illusion?
It should be if it isn't.
It should be. Yeah, as you said, it's been tough for the industry, but it's been tough for Walgreens specifically, kind of after its merger between Walgreens and Boots. It's sort of has struggled to find its way even since then. And then, as you said, the reimbursements because of in the insurance industry have made it even more tough. So it looks like investors are treating it as maybe all the way dead,
Stocks
maybe not just
about,
mostly dead.
Down about 50% now.
Yeah, it's been tough. Let's talk about Pfizer as well. That company reportedly has avoided a battle for now with activist investor Starboard Value. That's according to Bloomberg. How has it avoided the battle? Well, Starboard, the deadline has passed for Starboard to nominate new advisors to the board. It hasn't done so. Does that signal some sort of détente between the management and Starboard? That much is unclear, but for now, no new escalation in the attack.
Yeah, this stock, another one that's been hit hard. Demand for COVID medicines, as we've talked about, Julie, on the show, not obviously what they used to be. Not over yet, it doesn't sound like, as Bloomberg does note in the piece, Starboard, which took roughly, I think, $1 billion stake in Pfizer last year, could still propose changes to the board in 26. I guess if the two sides don't reach a settlement before then, so we'll continue to watch.
Yes, we will. Well, as the impact of China's DeepSeek ripples through chip stocks today, we've got one strategist who says not to overreact to the news, but the true test for markets is coming later this week. From where we want to welcome in Kenny Palcari, Chief Market Strategist at Slate Stone Wealth and host of the brand newest Yahoo Finance podcast, Trader Talk. It airs every Wednesday at noon. Kenny, good to see you. Thanks for being here.
Good to be here. Thank you for having me.
So there seem to be a lot of people who are saying, whoa, this is an overreaction today, but isn't it also a reflection of maybe people had gotten too, the positioning, even though we talked about hedge fund and mutual fund positioning pulling back a little bit, there's so much enthusiasm for these stocks.
100%, and it's been building right over the last couple of months, and we've been talking about that. I've been talking about that. I've been saying to people when they want to get into tech, listen, don't chase it because it's stretched. You already own it, you're participating, so you're good. But I wouldn't be chasing tech up here, and all we needed was one single catalyst to create what we saw today. Now, we got that catalyst over the weekend. I'm not a big believer in this whole DeepSeek story at all. I find it...
Why do you say that?
Because I find it really interesting that here we are in America spending billions of dollars, some of the greatest minds in the world, in the country, putting this AI stuff together, large language models, all that stuff. And then we get some guy from China in a startup company that comes out and he does it with lower quality chips and an open AI system that functions better than what we've been designing. It just doesn't make sense.
I mean, isn't that just American chauvinism, though, saying that?
I don't know. I can't believe he's doing it for a fraction of the money that we're spending.
I will say, Kenny, to Kenny's point, there are analysts. I saw some guys on the street today saying,
Dan Ives.
Well, they were saying the timing is curious to them. In that, not just but is this timing, could it also be about, here's a theory, about they're trying to kind of leverage Trump tariffs, minimize the hit, was another theory that's out there. The geopolitical angle that's out there.
Like we're okay even with the export controls.
Yeah, but I'm just not buying it. I got to tell you, I'm just not buying it. Now, did the sector need to pull back? It absolutely did. And was that the catalyst? It certainly was. I mean, look, at one point, Nvidia was down 15% in 2 days between Friday and today, right? And some of the other names in that industry all down 10, 11% coming into this morning. But we saw the market, actually, the Nasdaq, was down more than 1,000 points and has rallied back. I don't know where it is exactly right now, but the Dow actually went green after being negative, right? And so I think people are trying to assess exactly what they heard. They're talking about it. It's all over Twitter. Everyone's talking about it. And so people are beginning to wonder, is this just more? So
you didn't download the app, that's what you're saying.
I did not download the app. And by the way, here's another thing.
Your kids download the app?
No. First of all, I have adults, right? My kids are now adults.
They're always kids.
You wouldn't even know if they did download the app.
I know. I wouldn't know that. But my kids wouldn't download the app. But here's the deal. Once again, we're talking China. They take everything, all the data. Right? They take all the data, and actually somebody posted on Twitter right off of their consent page that they tell you they're taking all the data, they're storing it over in China. I don't get what people don't get about that. Like, why would you want to do that? And by the way,
people don't care, Kenny.
If you're building a business using AI, why would you want to get in bed like that?
And if you're just a person, you don't care.
If you're just a person, you don't care. But if you're talking about building a business, why would you want to do that?
Okay, quick question. Let's take a step back here. I was looking at this chart about the returns in the S&P 500 last year. 57% of the market value added to the S&P last year was from the Magnificent Seven.
I hear you.
$2 trillion from Nvidia alone. So this is sort of the journal came up with this sort of graphic looking at the beaker, if you will, of the S&P 500 last year. Yeah. So like, what is this? Is this year going to look like that?
No, I don't think it is. And I'm okay with that because I think that it had gotten too stretched. It had gotten too far ahead of itself. And it was a crowded trade. Everybody was in it. Oh my God, oh my God. I think you have to own tech. I think you have to own AI, but I don't think it needs to be way overweight in your portfolio. And by the way, I think if it underperforms this year, I wouldn't be surprised. Look what it's been performing over the last couple of years. At some point, there's got to be kind of a return to some sense of normalcy. Like I think the S&P, if we return 10 to 12% this year, which would be a really decent performance, people are going to go, oh my God, that's a failure because the last 2 years it was 25+%. They're going to look at it as if it was a failure. I don't think it's a failure at all. I think it's a return. I think it got a little bit stretched.
Right.
And so now it's this return to normalcy, and people have to understand that.
I mean, you may not think people should be overweight, but like you're sort of overweight already. Even if you're just market weight,
right, you're overweight.
Very exposed.
Okay, which is why when you're building a portfolio, then you should with using either ETFs or individual names, include other sectors that's going to actually bring that weighting down, right? So like Art was saying, and I love Art, but healthcare, financials are places, consumer staples, which are boring and not sexy at all, but they offer stability for a portfolio, right? And they offer diversification.
Yeah.
Boring, not sexy, but stable.
Right.
Yeah.
There you go.
There's something to be said for that.
Now, that's not me, but I'm just saying.
Kenny, great to see you, my friend. Be sure to scan the QR code below to check out the Yahoo Finance podcast, Trader Talk. That's every Wednesday at 12 p.m. Eastern, as Kenny Polcari brings you expert advice and key market insights from the New York Stock Exchange. Here's a look at this week's episode.
Look at every tech bust that we've had, where we've had like a horrible year in tech. The next year, you get these, high double-digit, triple-digit returns, and investors who have, systematic process to buy stocks over time. They're the ones who benefit.
They're the ones who benefit because I don't think quantum's going away.
No,
I don't think it's going away.
Right. The innovation didn't stop because he came out and said that.
No, exactly right. And look, the innovation didn't stop when they were questioning AI. And listen, I was the perfect one to say I'm not talking to a computer. Yep. I can't stand it. I want to talk to you. Now I talk to
every day.
I talk to my ChatGPT like it's you.
Right.
I'm having a conversation because you say, "Good morning, ChatGPT," and it says to you, "Good morning, how are you?" And I scratch my head going, "Who am I talking?"
Right. And just think about how far it's come so fast.
So
the point being with quantum as well, right? I mean, you had the CEO of IBM come out and say that by 2033, they're going to be delivering this high-level quantum computer with like qubits at its best, right? And so who's right? The guy who's working on that thing or the guy who's watching the work on the thing? I don't know. I think there's a lot to be said.
I think you also have to think about who's saying it, right?
Yes.
Jensen Huang, I get it. He's brilliant. He's done an amazing job with Nvidia. There are a lot of very wealthy people because of him.
Of course,
I get it.
Of course.
But you also have to kind of scratch your head when he makes comments like that at the CES. Is he talking his own book? Is he trying to knock the other ones out of place so that they focus on him?
Yeah.
A little bit. I feel like a little bit that's what's happening, or that's what happened.
I think it's a little bit of that, and I think that it's also a little bit of maybe like a glorified larger statement than it needed to be, because nobody can predict whether or not quantum computers are going to be flawless and work really well in 3 years, 5 years, 10 years, or 15 years.
Right.
The same way we can't predict whether all of the AI inputs are going to work.
And to your point, who thought even a year ago that AI would be where it is today?
Right.
And the way that people are using AI, right? I mean, people are using ChatGPT and Magi and all these other ones in ways that they probably never even imagined when we first started talking about these names. But now it's like second nature.
And the world has actually changed because of it. Like if you look at ChatGPT, when you had initially started to use it, like it was error ridden, right? You couldn't really rely on it for everything.
Right.
Now it's pretty good.
It's pretty good.
It
is pretty good.
All right, let's get to our call of the day now, and that would be Plug Power. Shares sliding today after that stock was downgraded to sell from neutral in a new note by Seaport Research Partners. You can see there. So sets the price target, by the way. This is a street low you're looking at, Julie Hyman. $1.
Yeah.
Talks about escalating headwinds, suggesting the worst isn't over. Risk to both top line and margins. They talk about politically related uncertainties amidst this backdrop. We've again cut estimates. This stock has already been, of course, nailed hard.
Yeah.
I mean, it's down about 50% over the past year, but Seaport apparently thinks they look at that and say, you know what, all the bad news not yet priced in. They tell their clients, avoid this one.
So basically what they're saying is the market in North America isn't good. The market in Europe isn't good, and those are the two biggest markets for this company. So basically they say the White House here in the U.S. has called for a 90-day freeze and review of the Department of Energy's hydrogen program. And they said most of the grants haven't even gone out so far. So there's that. And then in Germany, which should be one of the stronger markets as well, those things are not looking good. The vice chancellor there abandoned the Power Plant Security Act, which would have been supportive of construction of these plants. So it's mostly sort of political macro.
None of that sounded good.
None of it sounds great. And then
now that is not now we should note, most are not sells. Most are I'm just looking at, most are still a hold on this one, but tough no.
Yes, it is indeed. The Federal Reserve is expected to hold rates steady at its policy meeting this week, and this will be the first meeting taking place with Donald Trump back in the White House. Trump is already putting pressure on the Fed, making remarks last week at the World Economic Forum, demanding interest rates come down immediately. Here to discuss is Robert Kaplan, Goldman Sachs Vice Chairman and former Federal Reserve Bank of Dallas President. Rob, thank you so much for joining us. I think we have to dive into the political aspect of this a little bit. You know, and Jay Powell, of course, has been very steadfast in pushing back against any suggestion that there would be political pressure brought to bear successfully on the Fed. Do you think how does he sort of toe that line as the pressure does get to be more?
So let me explain it in stages, the way I think Jay Powell is thinking and the way I'd recommend he think. Number one, inflation progress is stalled out a little bit. Some things are getting better, some things are getting worse. We're going a little bit sideways, stuck in the mid-twos. So the Fed's cut 100 basis points, and I think it's appropriate to pause, and that's what they'll do in the January meeting. In addition, you've got 5 big structural changes going on right now away from the Fed. Government spending is going to get restructured, and I think government spending will be cut. Some of the previous programs will be put on hold with the intention of lowering debt to GDP, or at least moderating its growth. There's going to be a regulatory review in every industry with the intention, I think, to unleash more productivity growth. There's going to be an effort to lower energy prices and improve the whole energy ecosystem from drilling to transmission, refineries. We'll see if it succeeds, but that's the intention. We know we're in the middle of deporting a certain number of workers. We just don't know how far the deportations will go and how much workforce growth will be. And lastly, you've got the whole tariff discussion. Is it a negotiating tool? Are they actually going to be put on? What's going to be the treatment of Mexico and Canada in particular? Because that's what allows U.S. companies to domicile here, many of them, the intermediate goods. So got all that uncertainty. That's another reason to pause. And I'm not saying how long they're going to pause for, and I don't think he should say. They're going to skip January. He should then, they will be at the Fed, I would guess, furiously trying to understand these different policy changes and understand the impact they'll have, but that could take some time. And when Jay Powell says he's not going to be subject to political influence, he really's got to wait until they have conviction on what they're seeing and they see demonstrable evidence of inflation improvement before they could take any next step. And so, it could get uncomfortable here, depending on how long they pause. But if I were him, I wouldn't say I'm going to pause past, I don't know how long we're going to pause, and I wouldn't rule out March. but he doesn't know yet because we don't know how these puzzle pieces are going to unfold.
And Rob, you talk about the structural changes here, but there are also, personnel changes, meaning 4 Fed presidents rotating, Rob, into these voting roles on the FOMC, and 3 of them are thought of as inflation hawks. So what role does that play?
So during my years at the Fed, there were times I was called the dove. There was times I was called the hawk. I don't know that these labels mean that much. I think as a group, there'll be differences of opinion, but by and large, I think they'll agree on we need to see demonstrable evidence of continued disinflation before we do further rate cuts. There'll be differences around that, but I think that'll be their core view. And so I think even with new people, I think they'll congeal around that point of view. It's just the issue is we don't know the impact of all these different changes. My hope is they'll be positive and that disinflation will continue so that the Fed can move, but we just don't know that yet.
Well, and I guess that was the other thing I was going to ask you about, where you sit on that question of whether inflation is reaccelerating now or will it reaccelerate? Like, what are you watching to try and figure that out?
Through December, my own feeling was excess fiscal spending, historically high fiscal spending, was contributing to making inflation stickier, was blunting to some extent monetary policy. We're about to change that. We don't know how DOGE will do. We know they're going to pause some of these programs, but I think the effort, I believe, is going to be to more organic growth. If that were to succeed, my own view is over time, that would be disinflationary. Regulatory review is disinflationary. Improving the energy ecosystem is disinflationary. Tariffs, it depends how they do them. I wouldn't prejudge yet whether they're going to be inflationary or disinflationary. And labor force growth, if we had positive labor force growth, that would be helpful. But the point is, I don't know on those last two. So I'm cautiously optimistic, but I want to see the decisions that are made. And we don't know the decisions yet. They haven't been made yet. They haven't been announced. We don't know how far the deportations will go. We don't know what DOGE is going to be. We don't know what the tariffs are going to be. We will, and we may know soon. And you've got to understand those pieces before I would need to understand those before I was comfortable making a judgment about what was appropriate to do next.
Rob, finally, I'm just curious what you make of President Trump's recent comments about the Fed. He's talking tough. He's pushing for interest rate cuts, Rob. He says the Fed should be listening to him. I know the Fed, central bankers will say they're politically independent. They follow the data. But, they're also human beings, Rob. They wake up, they read the paper, they got friends and family. Can they really be truly and totally independent, immune from pressure from President of the United States?
So I was at the Fed during the first Trump term. My own view is this: you're going to get criticized if you're at the Fed, whatever you do. If you pause, you're going to get criticized. If you move one way or the other, you're going to get criticized. In light of that, my best approach and advice is have a thick skin, work as hard as you can, make the best judgments you can, do your analysis, talk to contacts, look at everything you can, and make your best judgment without regard to political influence or political pressure. And I think that's what they'll do. And yes, you may need to have a thick skin during this period for the next number of months, but I think that's the approach they ought to and I believe will take.
Rob, it'll be an interesting press conference, that's for sure, on this week. Thank you so much. Appreciate it.
Thank you.
Coming up, Tesla is set to report its latest earnings on Wednesday. We're joined by an analyst on the other side to preview what to expect from the EV maker. Stick around, much more market domination still to come.
General Motors reporting fourth quarter results after the close tomorrow. The big three automaker hoping to continue its strong run of quarterly performances. But challenges with EVs in China still loom. Joining to preview GM's report tomorrow is Yahoo Finance senior autos reporter, Pras Subramanian. Pras.
Hey, how you doing, Josh? So yeah, GM basically blew it out of the water last three quarters, just upping guidance 3 times, beating on earnings, beating on profit, and revenue. Just really kind of putting in investors' minds like this is what they do from quarter to quarter. But the question is now, there are some issues coming up, right? So before we get into that, talking about just top level numbers here, revenue of $44.45 billion is estimated. Again, higher than a year ago on $1.83 and adjusted EPS. So good numbers there. Like I said, up guidance 3 times last year. Now looking at $14-15 billion in adjusted EBIT, which is higher than last year as well. So compared to a year ago. So strong numbers there, but the concerns are here, right? You have them winding down their cruise business, the autonomous driving unit. You have them taking a $5 billion charge in the China business in Q4 as well. Then you have Trump's trade war, right? Tariffs on Mexican products, tariffs on Chinese products, and then also the plans, or Trump's plans, potentially get rid of the EV tax credit. So some headwinds there. How are they going to affect the numbers? 2025 is the big question, I think, for investors tonight, or tomorrow morning, I should say.
We'll find out.
All right, we shall. Pras, thank you. Appreciate it. And tune in to Yahoo Finance tomorrow in the 9 o'clock hour as General Motors CEO Mary Barra joins the morning brief.
According to our next guest, Tesla investors should buckle up because it could be a bumpy road ahead for the EV maker. Joining us now to help preview Tesla earnings is Ron Yevsikov, Guggenheim Securities Director of Automotive Equity Research. Ron, it's good to see you. You have a sell rating on Tesla. We should just say that off the bat here. So you don't think folks should be buying the stock, to say the least, going into the numbers. And in particular, there's always a lot of attention to automotive margins. You think that number is going to be weaker than the street expects. Why?
Yeah, so based on the data we've tracked intra-quarter, we do see a more than 100 basis point miss on auto gross margins, excluding regulatory credits in the fourth quarter. Tesla was quite promotional in the fourth quarter to try and hit their volume growth targets for the year. And as a result, the revenue per vehicle essentially is going to be quite a bit weaker than the street is forecasting. It's always tricky to model. There's everything from inventory discounts at Tesla to promotional financing. And in the fourth quarter, you even had quite a bit of step up in things like free supercharging miles. But we are pretty confident that both the revenue per unit and then as a result, gross margin will fall quite a bit short of street expectations in the fourth quarter.
Ron, I know you have a sell on the name, but the stock has had this just tremendous run, Ron, right? I mean, it's up more than 100% over the past 12 months. Or, looking back, Ron, and also maybe looking forward, were there parts of the Tesla story that you think maybe you underestimated?
Yeah, I think certainly the market's willingness to ascribe an outsized valuation to Tesla's autonomous efforts has been surprising, but I would say the biggest surprise has been the post-election move. And so you've seen a large increase in Tesla's valuation. The vast majority of that 100% you've talked about came post-election on the idea that the incoming Trump and now the current Trump administration is positive for autonomous vehicles. And I would just say we would push back that the vast majority of the bottlenecks on Tesla's kind of pathway to robo-taxis and self-driving vehicles is going to come in the form of state and local regulators that have the ability really to control what goes on the road in their jurisdictions, as well as just technological progress. I think there's a view that Trump has this small positive percentage increase in a very large TAM, but at the end of the day, the bottlenecks really haven't changed towards Tesla's robotaxi and FSD ambitions, and that has been a real surprise to us.
Ron, I want to ask you about the energy storage side of the business too, because a lot of the bulls have been pointing to that side as being a real bright spot over the last few quarters. Do you think that's something that could, I wouldn't say outweigh what's going on in the auto business, but at least be a silver lining?
Yeah, the growth in energy has been, and we have been pretty consistently ahead of street estimates for energy storage. Actually, I feel like we have a good handle in our model and thus in kind of our discounted cash flow basis for the growth in energy storage. That there are some positive developments coming in 2025, the Shanghai mega factory. ultimately, that it still is kind of a price times quantity business. We feel pretty comfortable modeling this. The hardest part of Tesla's business to model is this kind of binary bet on Tesla solving self-driving and having a dramatically better cost than everyone else, and being able to kind of go over the top of other ride-sharing networks. And that is much more challenging to ascribe. I think there's a very wide range of outcomes for how to value that business, and that is more of a challenge, I would say, in terms of valuation.
You know, Rob, a common observation, Musk has a lot going on. I mean, he's always had a lot going on. But now, on top of everything else, Ron, you can throw in Doge, our new Department of Government Efficiency. I'm just curious, as a financial analyst, do you look at that and think, okay, at this point, any concerns about his focus and his attention on Tesla, that he just seems too stretched?
Not really. I would say, actually, even as a team, we were far less vocal around the things like the Twitter acquisition and kind of bandwidth issues there. I think that Elon has shown a propensity to be able to manage many businesses at once and delegate where needed. I think our valuation is much more driven by a kind of a rigorous DCF, where this stock will be fortunate to generate more than $5 billion of free cash flow next year. At the current $1.5 trillion valuation, the valuation is a massive outlier. Even at our valuation, the free cash flow yield would be less than 1%. At the current valuation, it is really difficult to get a real payback on the stock, at least based on cash flows.
Ron, I was looking back. I believe that you've been a sell now, going back to around February of 2023, if I'm not mistaken. And the stock's up in that period of time quite a bit. So I'm curious, what would, there's a lot of faith built into this stock, not just a DCF, right? There are other things affecting it. What would change your mind, though, about Tesla?
Yeah, I mean, I think the current valuation, you need to ascribe an outsized valuation either to robotaxis or robots. And that is really the only way you can get anywhere close to the current share price. And so positive developments on that front would certainly change our view. We do have Tesla planning to launch the robotaxi pilot at some point this year. We think it'll be in Texas, but they have said Texas and or California. And then robots are a little tougher for us to get a good handle on. I think even developments this morning with DeepSeek are probably an incremental negative for robotics. Just the barriers of developing AI models are coming down in terms of cost, and if that is one of the barriers to entry here, it's certainly weaker today than it was yesterday.
Ron, always good to see you, to have you on the show. Thank you for joining us.
Thanks for having me.
And while wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for market domination overtime.
There's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickery to get you up to speed on the action from today's session. I'm going to start with where the major averages ended the day, which is pretty much at the highs or off the lows, depending on how you want to slice it here. The Dow up 289.6%, so really bucking this DeepSeek-induced sell-off that affected tech so strongly here. That Chinese AI model that was introduced just about a week ago, really building momentum and causing a lot of concern about the AI story here in the United States. And so while the Dow was up, the S&P 500 off 1.5%, and the Nasdaq, which fell as much as around 3.5% at one point during the day, still finishing down 3.1%, being dragged lower by huge declines in stocks like Nvidia and Broadcom. So that definitely reflected also in the fact that the S&P equal weight was little changed, even as we saw that deep selling being pulled lower, especially by large cap technology. I'm sure Jared's got a deeper dive into all of this and that just frenzy of selling that we saw today, Jared.
Thank you, Julie. They say rotation is the lifeblood of bull markets, and we have seen rotation here today. Get rid of the mega caps, get rid of a lot of the AI trade that's been high flying and doing a little bit too well. Go into some other markets here. So we're seeing the S&P 500 equal weight barely eking out a gain there. Dow's up a few hundred points. As you point out, the Nasdaq had a nasty day, but I want to show you what's going on in the bond market, and then we can get to some heat maps and some positive action for the day. 10-year was down 10 basis points by coincidence. US dollar index also down a little bit. Sometimes when you see steep declines, that can indicate a problem. I don't see that today. I see this as just normal rotation within the market that we have. And is there an existential crisis with the AI-driven bull market? I don't see that just yet, but that could develop over time. Here's the sector action. You're seeing tech along with utilities as the only two underperformers. Look at that, tech down almost 5%. Semiconductors had the worst day since the pandemic, so did Nvidia. We'll see if we have time for that. But Staples got a lot of love today, up 2.76%. Walmart had a record close. That was the first one of this year. Healthcare was doing well. Eli Lilly up a considerable amount today, at least in market cap value. Financials third, real estate, then consumer discretionary. So we did have a lot of winners today, and you can see that in some of the heat maps where we focus on that. And here, in fact, are the S&P 500 winners. Excuse me, those are the losers. We're going to get the winners here. Apple had a big day, bouncing off of its 200-day moving average, which it did last week. So we're going to get into this, Josh, in about 20, 30 minutes. So you take it from here.
All right. Thank you, Jared. Investors rattled as China's DeepSeek triggered a sharp sell-off in Nvidia shares. Our next guest says the selling was aggressive because there was so much momentum behind the upside. Joining us now is Jay Hatfield, Infrastructure Capital Advisors CEO and CIO. Jay, great to see you.
Josh and Julia, great to be on your show.
So let's start with the story of the day. DeepSeek. Here's this Chinese company, Jay, and they say, here's what we did. We created a model. We did it fast. We did it with older chips. We did it with fewer chips. We spent a whole lot less than you Americans did. And I think investors are trying to look at that, Jay, and they're saying, okay, well, if those claims are actually all true, what does that actually mean for this mega AI trade, which has been, of course, so critical to the market? But what are you made of it?
Well, I think one area where we can add some value is on the power and gas side. I used to be a utility investment banker, and we run an MLP fund. And those stocks were just way ahead of themselves. Because that's an old economy business. It used to trade at 12 times, and I was trading at 25 times, implying this enormous growth of power, which I think was unrealistic. Because inevitably, maybe it's surprising it happens so quickly. But these tech software projects always get more efficient. So we think that area was the most overvalued. But we do think that with regard to the chip stocks, like we've been recommending, AVGO, Broadcom, that having lower costs actually will have broader applications. The big short thesis has been the ROI is going to be terrible. Nobody's actually going to adopt any. It's just going to be hyperscalers and miners, and the miners aren't going to find any gold. So I actually think if it's more efficient, probably better. And those stocks, surprisingly, they're about as expensive as power and gas companies, but they have better margins. So they're trading with implied growth rates of 13 to 15%, which is not crazy and consistent with lower costs, consistent growth, but not this skyrocketing growth that we had over the last 2 or 3 years.
Well, it's interesting because Broadcom, of course, got a lot of attention late last year on this thinking that it was going to sort of take over from Nvidia and be the contract chip maker for companies that didn't want to pay for the Nvidia chips. But if the thinking is that the process of creating these models might be less intensive, doesn't that mean there would be fewer chips needed overall, even from a Broadcom, or is that taking too much of a leap?
Well, I think that's still ambiguous because you get growth from lower costs because you have more applications, because this was, arguably uneconomic for just regular corporations to run these, to do all the calculations in large language models. Now it's going to be way lower cost, and we have seen good adoption on the CRM side. So Salesforce is getting good adoption. So I think that those are somewhat offsetting, and the multiple, it's not like Nvidia, like during the .com boom, like AOL was trading like 350 times earnings. It's trading at 25 times earnings, which implies like a 13% growth rate. So you could have a deceleration, some broadening of the market, and it would still entirely justify these valuations. So we think it's a little bit different than the power and gas side that was just arguably flat out way too high. And I don't think it's almost impossible to install that much electric capacity. You kind of had to have some breakthrough to reduce the power requirements.
Jay, broader market question. Do you look at today's action and say, okay, Nasdaq, SPX took it on the chin. Do you see it as just, listen, it was a one day, one headline, or no, should you, if you're an investor, be thinking maybe this could be kind of the start of something more serious?
Well, you already really mentioned it. So a good sign of a bull market is it's more rotational than straight down. So if everybody's just flushing every stock in their portfolio, then I'd say, oh my gosh, go buy your puts and be super cautious. But two things. So we had the rotation you discussed. Actually, great. We have a new bond fund, BNDS, and our main fund. They're both up today. So we finally broke this. We've talked in the past, we're bullish on bonds, nobody else is. So we broke that fever. There's like 2% other people. We broke that fever, so bonds are higher, fixed income is higher. So if given that rotation, I think that's bullish. And also, we're going into earnings, so we can get some answers on these questions. What does Microsoft think? Is there going to be a broadening market? Is there going to be more demand because it's lower cost? So it's better than if it's like mid-September and you're a month and a half away from hearing from the companies and it's just fears. Because fears will continue that the demand's going to collapse.
So sort of following on with this and talking about market concentration, I was taken by a chart I saw this morning in the Wall Street Journal looking at the contributions last year from the Magnificent Seven to the S&P 500. And this is what it looks like with Nvidia contributing $2 trillion of the almost $10 trillion total. So all the Mag 7 was 57% of the market value gains last year. What happens this year in terms of that? Everybody keeps talking about broadening out. Do you think that is what happens? And what does that look like?
Well, I think that, we do need some answers on the impact of today's announcement, but let's assume that it's sort of a little bit status quo, that we're growing maybe not as fast as we thought on the A side. But the critical element was the conversation we were having last time I was on. You've got to get the interest rate call right. If you tell me absolutely we're going to have 5% treasuries, say, okay, I'm not certain where the market will be because maybe AI is just infinitely highly valued, but you wouldn't want to depend on any counter rotation. If we're right, inflation, we think inflation's coming down, economy's slowing on the real economy slowing, and rates are at 375 or 350 to 4 is our estimate, then almost certainly you'd have a rotation and kind of our stocks, because we don't have a lot of tech stocks, value, income, bonds, preferreds, will do really well in that environment. Now, they may not beat tech stocks, but you have to keep in mind, tech stocks have twice the risk, you saw it today, twice the risk of even Goldman Sachs or higher beta non-tech stocks. So I think that I need that input to be sure. We're forecasting that. We've been really called this cycle well because we look at monetary policy versus just the labor market, but we're not infallible. So that we have to be right about rates to get the rotation right.
Well, we'll check in with you soon to see how the rate picture shakes out. Jay, good to see you. Thanks for coming in.
Thanks for being on.
Appreciate it. Well, Colombia is accepting deportation flights again after a 10-hour standoff with President Donald Trump. Trump threatened 25% tariffs if the country did not take those flights. For more on what we learned from that standoff and what it might mean for future trade clashes with Canada, Mexico, China, and whoever else, we're bringing in Yahoo Finance Washington correspondent Ben Worschkel. So what were the takeaways from this episode, Ben?
Yeah, Julie. Yeah, so you know about the 10 years war, call this the 10-hour war. As you mentioned, this started as a standoff that began kind of out of the blue on Sunday afternoon, with Trump immediately going, as he often does, to tariffs. And it's sort of important because this Saturday is a deadline that Trump has imposed for Canada, Mexico, and China, where he's also looking to have tariffs. So 3 takeaways from this brief episode that I think give us insight into there. First is the sort of speed and intensity of it. Trump, within hours, I mean, I don't know if the planes might have literally have still been in the air, and Trump was out with this tariff threat, 25% in the first week, which he actually said would be 50% in the week after. So it was the intensity of it and the kind of no hesitation about going the tariff route that all indications are were willing and ready to enact. The second is a technical note that's really important for trade observers, for close trade observers, which is that this is the first confirmation from this White House that the way they actually want to implement, they wanted to implement these Colombia tariffs was a 1977 law called the International Emergency Economic Powers Act. And the takeaway for that for people is that this is the quickest, fastest way to do tariffs that Trump has long toyed with, but it's not what he used for tariffs, at least in the first term. The estimation here is that he could announce the tariffs, he could formally do it, and they could be in place 12 hours later. So in the Colombia case, they seem to be ready to have tariffs in place right now as we're speaking. And then third, it sort of shows the kind of free tariff reign that Trump has here. Congress has ceded a lot of their power, and a lot of what you saw yesterday in this 10-hour window was his allies in Congress saying, do whatever you want on tariffs. So he's clearly kind of ready to go on tariffs, and it's the mood music for this Saturday, where with these 25% tariffs on Canada and Mexico and 10% tariffs on China possible, he's clearly where his head at as he heads to this deadline, which we're all watching to see what he actually implements on that this weekend.
You know, but as I was following along on X watching this, I mean, the exchange with Colombia, it was just remarkable to watch, Ben. I mean, as someone who knows Washington backwards and forwards, explain to us how it was different than traditionally, usually, typically, an issue like that would have been worked through.
Yeah, I mean, the usual way to do this in kind of every president that's not Trump is that there would be a whole planning stage for this, and then there would be a kind of fact sheet that would come out about this. There was none of that. This clearly happened. There was no situation room reading where they planned this out and made these all tariffs. Trump, he was in Florida. He heard about this flight that had been diverted and had sent back, and he was right out with the threats. And it was tariffs and a whole bunch of other things, including sanctions. And they were it was almost like a make the threat and then fill in the policy details afterwards, which is very Trump. I can remember this from Trump 1.0 was an aspect of this, but it's very different than definitely what we saw the last 4 years under Biden, for certain.
Yeah, very different indeed. Ben, thank you, my friend. Always good to have you on the show.
Talk to you later.
Be sure to scan the QR code below to check out Ben and the entire Capital Gains crew. That is every Friday, 12 p.m. Eastern on the Yahoo Finance homepage or wherever you get your podcast. Stick around. Much more market domination over time. That's coming right up.
Tech stocks selling off today on the emergence of China's new AI app DeepSeek and a new model it made. As news ripples through the markets, its impact could have even bigger implications for AI governance in the U.S. For more, we're bringing in Matt Calkins, CEO and founder of Appian. Matt, it's good to see you. And I thought of you when I was looking at this tweet from David Sachs, who, of course, is the AI czar and crypto czar for the White House. He said DeepSeek's R1, that's the new model, shows that the AI race will be very competitive. He also said President Trump was right to rescind the Biden executive order, which he said hamstrung American AI companies without asking whether China would do the same. I'm curious what you make of that view and sort of taking the guardrails off, if you will, for AI firms in the United States?
All right. The war for AI is going to be an asymmetric war between the U.S. and China and anybody else who gets involved. And the things that make us strong are not the same as that's going to make China strong. So we shouldn't worry about trying to match exactly the way they approach this. And I think we have a free hand to make policy. I do believe that the executive order that was rescinded recently, we're better without it. It was overhead. It was bureaucracy. I think, however, we would be wise to create a national regulatory framework and protect the rights of the privacy rights and copyright information rights of Americans. I think those would be a very American way to create a framework for succeeding at AI.
And talk a little bit more about that, Matt. I put you in charge now. Talk more about that framework. How would you flush it out? What would be the details of that?
Yeah, first of all, total transparency. We got to understand AI in order to regulate it properly. So it's important that we all understand whose data is training these models and how it just what data is being used. Once we understand that, we'll be able to make better, more enlightened laws about regulating AI. But we've got to understand, first of all, where the value comes from. This DeepSeek announcement is a wake-up call for everybody who thought they knew where the value came from. We thought it was the chips. Well, we need to think about that again. We thought it was the top-level expertise. We need to think about that again. We're not exactly sure, but in all, it reminds me very much of OpenAI. A couple of years ago, we would not have guessed that OpenAI would explode onto the scene as an AI leader. We thought it would be Google. We thought it would be somebody who'd invested more money. It turns out that OpenAI and DeepSeek are both capable of surprising us, and I would expect a bunch more surprises to come in an industry as volatile and innovative as AI. What we need to do is create just a clean framework, a national framework for laws. Don't do this at the state level. Don't put unnecessary overhead on our innovative companies, and still protect individual privacy rights. That's the way to do it, and I think David Sachs is on the right track.
And do you think that if that's the case, and even without that framework, do you think DeepSeek being Chinese is a competitive disadvantage? Do you think that there are companies who will say, I'm not going to use this model because I am concerned about what China, not just this company, but that the government in China might have access to my information?
I think DeepSeek is more important as a demonstration of possibility than it is as a product right now. As a product, I think a lot of people would have reservations about using it because of the Chinese ties, and there's some censorship mixed up there that we could probably get rid of, right? But the most important thing here is just the possibility that you could create an AI model, a winning, strong AI model with fewer chips and less money and no big name experts. That's an exhilarating possibility, and so the DeepSeek shockwave that's hitting the U.S. this week is the realization that there may be another unanticipated way to create great AI models.
Matt, I'm just curious whether you downloaded and experimented with the app, and if you did, Matt, are there ways that you do so, smartly, prudently, responsibly, given that it is a Chinese company?
Yeah, I don't download Chinese AI. I just don't, and I would draw the line there. I read a lot about it, but I would choose not to disclose any information.
But Matt, just to build on what you're talking about, is this sort of a clarion call for U.S. developers that they should be trying to do things more efficiently at lower cost, et cetera?
AI is an art and not a science. And the winners who appear to be winning today in AI may not be the winners in the future. We're still guessing. There's a remarkable amount of guesswork, chance, evolution.
Well, Matt, there's
in this industry.
I mean, I don't doubt what you say, but man, there's a lot of money being put to work on stuff that is guesswork and an art and chance, right?
An incredible amount, $245 billion of CapEx last year by the major AI firms. Just an astonishing amount of build out. And the question they've got to be asking themselves now is, what exactly did I buy? Am I a leader as a result of spending all that money? Or has somebody else found a cheaper way in which, I think they are leaders, to be fair, but I think they've got to ask themselves whether that's money well spent and whether they can convert it into revenue. That's the golden question in AI. We're going to spend all this infrastructure like we're building out the railroads all over again or creating the internet all over again. There's got to be an enormous payout at the other side of that. And these companies that have made the investment, they want to believe they're leaders.
I'm curious, Matt, would you expect to see companies, and I would expect maybe startups, younger, counting every nickel, to move toward this app? And yes, it might be a Chinese company, but there are concerns about cost. They may say, well, it's a Chinese company, but it is meaningfully cheaper than some of these American rivals.
Well, it's a lot cheaper, and also it's open source, so you could just take it, and maybe you could even disable the censorship. So yeah, it'll probably get used, definitely. But most importantly, it'll be used as an inspiration for how an upstart firm with a new idea could create a great AI product, and it's a demonstration of the fluidity of this market.
Matt, I couldn't help but noticing that Appian shares were up today at a time when we saw a lot of the ripple effect negative amongst big tech, up 3.5%. What are the implications, if any, for you guys from sort of a changing AI landscape?
Well, we don't create AI models, we merely use them. We're dedicated to making AI valuable in a business context, to implementing it and getting a return on the investment. And so the more accessible AI becomes, perhaps the more attractive becomes our value proposition. That might be the reason.
Matt, it's always great to see you. Thank you so much for joining us today. Appreciate it. Time now for What to Watch Tuesday, January 28th, sponsored by Tasty Trade. Leading off with earnings, we're going to be hearing from some big names tomorrow ahead of the open, including Boeing, JetBlue, RTX, and General Motors. Guidance for 2025 is in focus for investors. Analysts expecting sluggish demand for larger SUVs and trucks to weigh on the forecast. General Motors CEO Mary Barra will be joining Yahoo Finance tomorrow for an interview with Brian Sazi and Praz Submarinian. That's at 9:30 a.m. Eastern.
After the close, investors will be watching Starbucks, the coffee giant announcing first quarter results, and it marks the first full quarter under new CEO Brian Niccol. Analysts expect same-store sales and foot traffic to decline from a year ago. Tune in Wednesday when Yahoo Finance's Brian Sazi and Brooke DePalma will sit down with Niccol at 9 a.m. Eastern.
And finally, fresh consumer confidence data is coming out in the morning. Economists forecasting that number to tick up from last month to 105.7.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Rough day for the Nasdaq and the S&P, with China's DeepSeek AI model igniting a tech sell-off. The Dow managed to avoid much of the chaos, ending the day comfortably in the green. We're going to dive into the rest of today's market trends. Then crypto also getting hit by the DeepSeek disruption, dipping below 100,000 for the first time under Donald Trump's second administration, hitting an intraday low of just under 98,000. Plus, last week Target became the latest company to nix diversity, equity, and inclusion goals, and a growing wave of companies pulling back on DEI commitments following President Donald Trump's election. We'll take a look at what that shift means for businesses. The Nasdaq closing sharply lower on Monday as Chinese startup DeepSeek sparks concerns over U.S. leadership and profitability in AI. Yahoo Finance's Jared Blickery joining us now with the trading day takeaways. Jared.
Josh, we got to take a look at the carnage first. Nvidia clearly got whacked, and we're going to go to our S&P 500 heat map of the worst performers today in the S&P 500 by market cap. So just a few of these. Nvidia lost nearly $600 billion today. You can see it was down 17%. That was the worst performance since 2020. You'd have to go back to the depths of the pandemic. That would be March. You take a look at some of these other names. Broadcom, that was its worst day ever, almost $200 billion. Then we have Tesla, Alphabet, and the list goes on. A lot of these names down double digits. So this is serious stuff here, but big picture, I think the question on every investor's mind is, what is this setup for the future? Is the thesis of this bull market, which is based on AI, is that simply over? And I don't think it is, because we see a lot of rotation right now.
All right, Jared Blickery, point number 2. Tell me about it.
We got to take a look at some of the winners here. So Apple plus Lilly plus Walmart, just 3 examples. So if I'm going to go back, here and I'm going to show you the winners in our heat map here, and you're going to see Walmart just closed at a record high. Procter & Gamble had a banner day. Apple bouncing off of its 200-day moving average, that stock gained $108 billion in market cap. Eli Lilly, that stock is not dead. Well, it's up 3% right now. So my point is that there's been a lot of other instruments here rushing in to fill the void created by these large losses. Crypto, I'll even go to the crypto sphere. Bitcoin was down by like 5%, closed the day down maybe 2.5%. So things improved throughout the day here.
How much, when you look at a day like this, Jared, I mean, how much damage was done to the bull market in today's session?
We got to look at the VIX here, because that's what I'm using to gauge this. This is a 3-month chart, and you can see there's a little bit of a spike up here today. When the VIX goes up, generally that means there's something going wrong in the equities or the risk space. But I'm going to show you the intraday chart. This opens up early in the morning around 2 or 3 a.m. Eastern time, and you can see it gapped up quite a bit from Friday. Then it spiked higher, but for the most part, by the time the market opened down here, it was just trading sideways throughout the day. That's not a huge event when we look at the VIX. I'll show you on a 1-year chart some of the spikes that we had. This spike right here, that was December 18th of last year. That was that big Fed spike. This was Yen-mageddon. That was not even a US-centric event. And now we're talking about this event down here. So I go back to my original thesis that this is not necessarily a huge problem. And I want to get to a clip that we have from Kenny Glick. Now, he is a day trader, and we just interviewed him on Stocks in Translation. It's dropping tomorrow. He talked about how to trade the VIX, and specifically a VIX derivative called UVXY. Let's take a listen.
UVXY is a product that's basically built to go down, and it tries to reflect the fear of the day. So as a day trader, especially for the shorters who are, having a hard time right now, if UVXY shows any kind of strength, you know that the sellers are out there. And my God, if it's actually trending higher, UVXY, you know the market's in trouble.
And so that kind of relates to what I was just saying. VIX did not trend higher throughout the day. It gapped up, and for the most part, it went down from there. So I think this is more likely to be a one-off event than something bigger. But of course, things can change from day to day. I just want to close with this. This is the VIX fear gauge map. This is the average of what the VIX does every year going back to 1990. Guess what? We are somewhere right down here, and we are heading into March. The VIX tends to get higher. So we are in for some more events here that could raise the specter of risk within the markets. We're just not there yet.
Finally, quickly, dollar rates. lessons learned, Jared?
You know, I'm glad you brought that up because this is the last thing here now for real. The dollar and rates went down quite a bit. Here's the 10-year T-note yield. Here are these recent highs that were really concerning for investors. We were down 10 basis points today. That's not absolute fear, and that's actually a pretty good thing. You can see a little head and shoulders top here. If we go down a little bit more, probably points to a lower level somewhere in down here in the low fours. That would be welcome for these risk markets.
All right, Jared, thank you, buddy. Appreciate it. Bitcoin, as Jared was just mentioned, falling as it gets caught in the sharp drop in tech stocks. Chinese AI startup DeepSeek shaking markets as it raises concerns over U.S. profitability in AI. Here with more is professional capital management founder and CEO Anthony Pompliano. Anthony, it's always great to have you on the show. Let's start right there. DeepSeek, Anthony, because that was the headline today. I'm curious, Anthony, the reaction you saw off that in stocks and sectors with AI exposure. Did that reaction, that response, Anthony, did it make sense to you? Did you think it was overblown? How were you thinking through it?
Yeah, well, I think that mainstream investors have no clue what AI is. They couldn't describe to you how it works. And so anything that is new or surprising to them, frankly, drives fear. And if there's fear and uncertainty in the market, they sell and they go to dollars. So maybe it shouldn't be surprising, but I actually think that DeepSeek and the recent model that they published is really bullish for both AI and kind of tangentially Bitcoin and cryptocurrency as well. Anytime that you get, more effective technology in the market, especially through the open source channel, that should lead to much more productivity. That should lead to lower cost, and that should also lead to more problems solved in society. So I think that that's a pretty exciting thing on a macro basis.
DeepSeek made some, it's a lot of claims, Anthony, right? So they say, hey, we built this model and we did it fast and we did it with older chips and fewer chips and we did it a lot more cheaply than the American companies. I know some skeptics are pushing back on that, Anthony, a bit. Are you a skeptic, or no? These claims, they ring true to you?
Who cares? All we need to focus on is what we can control. And ultimately, what we can control is that American companies and American entrepreneurs should try as hard as they can to build the best model. And right now, we're getting our ass kicked. And so we need to figure out how to improve. We need to figure out how to build better models. And that's going to take capital. That's going to take a kind of strategic national priority coming down from the government to remove regulation and really empower these people. And then it's going to take ingenuity and entrepreneurship from the people with the experience and the skill set that is able to do this. But there is a global race for AI supremacy. The United States thought that we were going to get a free walk, that we were going to be the leader because we're the United States. But ultimately, American excellence is all about winning in the free market. And there's a competition going on, and hopefully the United States plans on winning it.
Did you download and experiment with the app yourself, Anthony?
I don't make a habit of putting Chinese software on my phone.
So that's a no. So you would have the same kind of, if the concern about TikTok is a national security concern, that's what Congress says. We'll see how that drama plays out. You would have the same concern about DeepSeek.
I don't have TikTok on my phone either. I think that there's quite a number of concerns. But, look, if you flip it around, the other argument is that if you're going to complain about people taking data and storing it in China, the U.S. is doing the same thing. We're taking data from outside of the United States and we're storing it in the U.S. That doesn't mean that we're doing anything nefarious or malicious with it, but I think that what you're getting is kind of these nationalistic perspectives. And so naturally, we have kind of a friendly adversary and a friendly competition with China. There's going to be a lot of people who are going to say, hey, anything they do is going to be bad for America. And a lot of people there are going to say anything that America does is bad for China. At the end of the day, we can only control what we can control. And so we've got to go win this battle. And the nice thing about this is we have the opportunity to do it. We have the best companies. We have some of the smartest people in the world. Just focus on it. Let's stop complaining about what somebody else is doing. Let's start competing in the free market.
Anthony, I got to end here with a question about Bitcoin. The action you saw there, why you think it was down today, Anthony? Was it a sign that this is just an asset that's going to be linked to big tech?
I think that there's a lot of people who hold Bitcoin and they look at it as a risk-on asset. And so if people are going to sell off in the stock market, they're going to go ahead and they're going to sell their Bitcoin. Remember, the holders of Bitcoin have significantly changed. We now have ETFs, we have Wall Street institutions, we have public corporations in some nation states. And so where it used to be kind of retail hardcore believers that were long-term holders of Bitcoin, there's a lot more kind of short-term oriented people that are now holding Bitcoin. If you notice, though, the drawdown was only 3, 4, 5%. That's a pretty small drawdown in kind of historical terms for Bitcoin. Usually we see 15 or 30% drawdowns during these bull markets. And so if it's only 3 to 5%, it's pretty much a nothing burger and we can move on.
Final question, Anthony. Just curious about the moves you've seen so far from President Trump and his administration with crypto. Did sign that EO, created the working group, evaluate the creation of a stockpile. What did you make of that, Anthony? Were you disappointed maybe that there wasn't more definitive immediate action?
No, look, I think if you're the president of the United States, you're coming into the White House, there's a whole bunch of priorities that you've got to assess. And one of the things you got to do is you got to get the right people in the right seats. If you want to have success over 4 years, then you've got to make sure you got the right team and they're focused on the right priorities. And so creating that working group is really important. I think putting David Sachs in charge of AI and crypto is really important, putting Bo Hines in place. And so now he feels like he's got the team there. Let's go have them do the work, and then they're going to start making decisions. But ultimately, I think that there's 3 things I've been saying from day one that Donald Trump needs to do. He needs to repeal SAB 121. The SEC just did that, so that's off the board. Then we've got to go and establish a national strategic reserve for Bitcoin. I think that President Trump will go and do that. And the third thing is we should change the tax treatment so that if you buy goods or services with Bitcoin, it isn't treated as capital gains tax. And so I think that there's hope that will happen as well. So 1 out of 3 already in the first week of his presidency is a pretty good track record, I think.
Anthony, always good to see and have you on the show. Thank you for joining us. Appreciate it.
Thanks for having me.
Coming up, Target, the latest company to backtrack its diversity, equity, and inclusion goals. I'm going to speak to activist Robbie Starbuck on the other side about the anti-DEI movement in the U.S. Stick around. Much more as for a trend. That's still to come.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Target became the latest major company in NIC's diversity, equity, and inclusion goals last week as part of a growing wave of corporations pulling back on their DEI commitments. And it comes as President Trump has already moved to eliminate federal DEI programs and slam diversity efforts while speaking virtually at the World Economic Forum in Davos last week. Joining us now is the individual some credit with spurring those corporate DEI rollbacks, Robbie Starbuck, conservative activist and filmmaker. Robbie, it is great to have you on the show. I wanted to start kind of high level, Robbie, because we do have this number of prominent companies making a change on how they approach diversity, right? Range of sectors, range of industries. It's been Meta, Walmart, McDonald's, Lowe's, Robbie. I'm curious why you think that is. What explains this trend? Is it, Robbie, Trump, Supreme Court, activists like yourself? Is it all of the above?
Well, to be perfectly honest, we planned it a lot of this way. So from the very beginning, we realized when we started this project that things had swung wildly to the left after George Floyd in such a way that if you look back in history, there's always a boomerang effect where it comes back the other direction. And we said, you know, how can we try to be a stabilizing force to get this to a place where it can really have a long-term, you know, impact on the way we do business in this country, but also just the culture we have. And we realized the best place to start was start with the companies that had largely right-wing demographics that were consumers, and then slowly inch our way into what we call jump ball companies, which are kind of like anybody's game, you know? And so that's what we did. And it was important to us to cross into different sectors because you needed to really capture momentum by doing that. And I think in many ways it demoralizes your opposition and makes them feel like there's sort of this unstoppable wave. And at this point, I think we've effectively, you know, made that wave feel like it's pretty unstoppable. And so the goal was always, as we got past the election into 2025, you know, we wanted there to be sort of these iconic companies that people wouldn't think would change. And that was always sort of the focus. And so that's where you look at your Meta and your McDonald's and most recently, you know, we just got Target, you know. So I think it's a measured thing to try to get us back to a place where we have a semblance of sanity. And I think it's important people understand, you know, you may not be conservative, you may disagree with my politics, and that's fine. I mean, that's America, right? We all kind of like have that capacity to disagree. And it used to be done in a, I think, much more intelligent way. But think about this. We can all agree that our country's super divided, right? I think everybody can concede that division has kind of ripped us apart at the seams over the past 6 years, 8 years, 10 years, really. And if we want to get back to some semblance of normalcy, we've got to start to rip out the vitriol from our daily lives. And so what changed over that 10-year period, one of the big things that changed was we pushed politics into schools, we pushed it into the workplace, and we got people at each other's throats and effectively made each other our enemies, right? And so if we want to peel back from that and get back to a place of sanity, one place we can start is the workplace. Workplaces can adopt corporate neutrality, which essentially is just a rule that, look, we don't get involved in divisive stuff. Like you do your thing politically or whatever you believe in outside of work, but the workplace is going to be about work. We're going to be a team, and we're going to treat everybody fairly, and that's it.
What about, Robbie, those companies that are not reversing on DEI? And you saw those headlines, Costco pushing back. You had JP Morgan's Jamie Dimon. Bring them on, he said, you know, about activist investors targeting DEI. What's your message to Costco, to Mr. Dimon?
So it's a very nuanced thing here, actually, because Costco's not quite in the same box as JP Morgan. So Costco doesn't have extremely radical DEI, but they do have DEI policies that I believe are going to be a major legal liability. I will say the way that they did what they did has been grossly sort of explained incorrectly by the media, because we did not approach Costco. All the other companies you named, we approached them, right? In Costco's case, there's a shareholder activist group. And they asked for there to be this, you know, proposal that they wanted passed by shareholders that essentially would have required them to spend money investigating the long-term effects of having these DEI policies. If you know a lot about how these shareholder proposals go, the company nearly universally, almost 100% of the time, recommends their shareholders to say no. And there's a very good reason for that, actually. if you've ever been an executive, you don't want to cede your executive authority to anybody else, right? And so if you ever have a shareholder proposal, no matter whether you like it or you hate it, if it comes and the idea is that these people are going to decide for you something that you believe should be an executive decision, you're always going to say, please vote against this because this should be under our authority, our control. So it's a little different than the other situations, but the media was so demoralized by everything we had done on the left that they needed something to latch onto, right? I think Costco's executives are just sort of learning about exactly what their DEI programs do and kind of getting familiar with the legal landscape. And I don't think we've heard the last of the Costco story, personally. I have engaged, I'll keep, all of that kind of off the record in terms of how and why and what we've discussed, but I have engaged and I have made sure they have all the information. And I think that, it's something that they're going to have to look very deeply at themselves and see if they think that they want to test the waters. But secondary, when you get to JP Morgan, just be very clear what we're talking about. JP Morgan said, basically, come at me, right? Is like his version of come at me, bro. And so this morning I went on CNBC and with Squawk Box, same place, Andrew Sorkin, who he talked to, me and Andrew talked. And I presented all the JP Morgan DEI policies that Jamie Dimon thinks are so incredible. And I think, any normal person can look at these. I'm looking at them on my table right now. And they would say, this is insane. This is not, some attempt to have fairness or equality.
Robbie, does that mean JP Morgan is a target for you?
JP Morgan is definitely a group we're going to be, I would say yes. Yes, they are going to end up being a target for us. We have a copious amount of evidence sitting here. Here, I'll show you some. See this? Genderbread man? Or genderbread person? Sorry, have you ever heard of this?
I have not, Robbie. But let me ask you, because I know time is limited.
This is one way they train employees on gender identity, okay? It's we're adults here. Is this not embarrassing to anybody? This should embarrass us as adults, that we have major multinational corporations training adults on gender identity with a gingerbread man in a poorly drawn sketch to try to explain away why I could just wake up tomorrow and say I'm Sally and Sally needs to be okay with me going in the bathroom with her. I think that's a little ludicrous. Then look at this. They had an explicit goal to hire 4,000 black apprentices, right, and full-time analysts. That's a quota. 4,000, that's a quota, and they reached it, okay? Racial quotas in our country are illegal. They've been illegal since the Civil Rights era. We have those laws on the books for all races. It's patently illegal. What has it resulted in? Resulted in this. This is 67% of their current internship class is minorities, okay? And I'm Latino myself, so it's not like I'm going off on some white supremacist thing here, okay? I'm saying it's very obviously they're flouting the law here, and they are intentionally building up classes that do not, you could never have this happen naturally in a multinational corporation where it's that far out of whack.
Let me ask you this, Robbie. If JP Morgan or any company, they have a vote, and their shareholders vote, and they vote in a way that maybe Robbie doesn't like, do you back off at that point, or no, at that point, despite a shareholder vote, even if it's overwhelming, that's where you double down on that?
There hasn't been a shareholder vote on these issues. The issues they had shareholder votes on, like say Costco recently, was doing a study on examining the long-term, impact of DEI. I'm not interested in that. I think these decisions are always going to be made at the executive level and should be made at the executive level, frankly, because if you entrust executives with your business, you're coming from the vantage point that you believe that they are going to act in the fiduciary best interests of shareholders, not in the best interests of their feelings, but in the best interests of them when it comes to their fiduciary capacity, okay? So to make money. And so at the end of the day, if you see the evidence that this is not making you money or that this is wasting you money, you should get away from it. And that's why it's been an easy sell to so many CEOs, because they understand that this has done nothing but bring division. It has lost them money. It's just been an absolute black hole since the very beginning. It was not what they thought it was going to be. They thought this was going to be about equality. Most of them didn't even know what equity was. And when you actually show them everything their companies are doing, most of them can't believe it. They think it's absurd. JP Morgan was sponsoring a mentorship program where the mentors were telling the kids in it that essentially if they talked to them about their gender identity or anything about their sexuality or proclivities, that they didn't have to share it with their parents. Okay?
Robbie,
this stuff's absurd.
Robbie, listen, I wish we didn't have to go. I could talk to you for hours more about the topic. We're going to have you back soon. Thank you so much for joining us, Robbie. That was great.
Thank you. Appreciate it.
Appreciate your time. Stick around. Much more Asking for a Trend still to come.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
For our chart of the day, we're taking a closer look at the market's reliance on the AI trade, and Yahoo Finance's Julie Hyman joins you now with a closer look. Julie.
Yeah, this is a look back, but it feels appropriate today given the depth of the sell-off that we had and the fact that it took down the Nasdaq and the S&P 500 by so much. This comes to us via the Wall Street Journal and basically looks at the gains in the S&P 500 last year that amounted to nearly $10 trillion and just how much of that was accounted for by the Magnificent Seven, or the AI trade, put another way. So this here is everything that's not the Magnificent Seven. And then all of this was the Magnificent Seven, which accounted for 57% of the gains that we saw in the S&P last year. Nvidia alone was $2.1 trillion of those gains last year. So when we talk about market concentration, this is what we're talking about, which last year worked to the upside, and in today's session worked very much to the downside as we saw that DeepSeek-induced sell-off. Now, not everybody in the Magnificent Seven was even down today, but the fact that Nvidia had a record single-day drop in terms of the value wiped off of that stock, well, that tells you something about this market concentration. Kenny Polcari, we had him on the show earlier of Slate Stone, and he talked a little bit about the perils of this concentration.
I think that it had gotten too stretched, it had gotten too far ahead of itself, and it was a crowded trade. Everybody was in it. Oh my God, oh my God. I think you have to own tech. I think you have to own AI, but I don't think it needs to be way overweight in your portfolio.
You know, and this is a conversation we've been having for quite some time, of course, Josh, this people calling for a broadening in the market that has only materialized really in fits and starts. And of course, the next big test of that will be the beginning of the Magnificent Seven earnings, which are happening this week. So we'll see what this chart looks like by the end of this year.
I think Kenny was also, remind me, Julie, somewhat skeptical of DeepSeek, was he not?
He was, but you can be skeptical of DeepSeek and its effects and also be skeptical of the dominance of big tech in the market right now, I think.
All right, thank you, Julie. Appreciate it. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.